crypto markets are becoming highly interconnected with the traditional financial sector. In time, DeFi could become a significant, if not the predominant, type of financial system. Hello and welcome back to Ethereum Audible, Ethereum in depth, where we read the best in Web3 and Ethereum, blockchain, crypto in general. I am Yehoshua Zlatogorsky, and we are going to continue today with Nick Carter and Linda Jeng's DeFi protocol risk paper, 36 pages. Last episode, we read through the first part. We started discussing the risks that DeFi bring to the table, new risks and amplifying old risks that all of these new protocols and financial instruments are bringing into our interconnected financial system. We'd love to think about DeFi as kind of the fixing factor for everything bad in the financial world, but the reality is that just like every other financial innovation, it brings advances, but it also brings new risk vectors that we have to take into account. I just finished reading a book called The History of Money by Niall Ferguson, and actually did a book club on it at Alpe Audio, which you can listen to. And there's this amazing story of John Law, the Scottish economist, who brings the ability to use stock ownership as collateral, which he imports from Amsterdam into France. And that's what creates the Mississippi bubble in France, and actually brings down the National French Bank, the Banque Royale, which John Law was the chairman of, the head honcho. And this system of collateralizing stock ownership worked really well in Amsterdam, and it didn't produce a bubble there for the first kind of century that it was being used. But in France, it did. And so you have this same financial innovation where in one sense it leads to prosperity, in another sense it leads to a financial bubble. And the same is true with DeFi, and that's why I think it's so important for us to be reading these papers that lay out these risks. So just to remind, they break down the risks into 5 general buckets. One is interconnections with the traditional financial system, which is what we went over last time. 2 is operational risks stemming from underlying blockchains, which is where we'll start today. 3 is smart contract-based vulnerabilities. 4, other governance and regulatory risks. And 5, scalability challenges. And today we're going to be starting with operational risks stemming from underlying blockchains. But before that, just as always, big shout out to Alpe Audio. You just heard the kind of content that we have there. A book club, 3 episodes on the history of money, kind of going through the main points there. And in addition to that, we have all kinds of audio courses, lessons, other book clubs. The idea is to bring audio courses that are in-depth, high quality, so that you can learn a topic from A to Z when you're on the go, listening, driving, commuting, at the gym, whatever it is, screen-free with audio. And every lesson comes with a summary, flashcards, chapters so that you can navigate better, and resources so that you can dive in deeper. And you can find all of that at Alpe Audio, ALPE Audio. And with that, let's go to operational risks stemming from underlying blockchains. DeFi applications ultimately rely on public blockchains for settlement and contract resolution. The most popular base layer, as measured by liquidity for such applications, is Ethereum, with around $46 billion worth of collateral, composed of various crypto assets and stablecoins, being employed in Ethereum-based smart contracts. A number of other blockchains now host DeFi applications and are eyeing Ethereum's lead. The orderly operation of these applications relies critically on these base layer blockchains functioning, which cannot always be guaranteed. Transacting parties internalize novel risks, which may have no analogs in traditional finance, where messaging and settlement systems are governed by single entities or bodies like SWIFT, the Clearinghouse, or the Federal Reserve with FedWire. Instead, public blockchains are largely decentralized settings where validators are compensated for assembling transactions into blocks and are expected to do so honestly based on economic incentives. As there are no central administrators in these systems, the responsibility for evaluating the risk or relying on these infrastructures effectively falls on the end users, applications, and new types of intermediaries involved in the DeFi systems. Consensus failures. Consensus, the construction, approval, and distribution of blocks of transaction across distributed ledgers on these blockchains, is however not a given. While the largest and most robust blockchains such as Bitcoin and Ethereum experience virtually no outages, outages are not completely unheard of. Bitcoin infamously had two major rollbacks in 2010 and 2013, when a significant number of blocks and hence transactions were unrecorded or essentially reversed. Collectively, around 15 hours worth of transactions were removed over the course of those two events. Ethereum is arguably more fragile to outages since most users do not run nodes but instead rely on service providers like Infura to query and index the blockchain and broadcast transactions. When those service providers experience downtime, as was the case with Infura during an unplanned chain split in 2020, intermediated transactions ground to a halt. Underlying protocol interventions. Blockchains are not immune to politics, as they are, after all, governed by the humans that established their rules. Most infamously, in 2016, Ethereum leadership coordinated the selective removal of balances from the blockchain after a particularly large DeFi application called the DAO was hacked and exploited. Ethereum leadership deemed it necessary to intervene on the Ethereum blockchain due to the large fraction of outstanding Ether locked in the Vault DAO contract. Some Ethereum community members rebelled against the arbitrary changes and supported the original Ethereum chain. The intervention caused a hard fork in the blockchain, as two versions of Ethereum came to exist in tandem, with the original but less widely adopted version ultimately being called Ethereum Classic. This is an example of a contract failure ultimately affecting the underlying protocol itself, and demonstrating that certain critically large applications can take on a systemic nature within protocol politics. At the time of the exploit, the DAO contract accounted for 15% of Ether outstanding at the time. While Ethereum leadership have not intervened to remediate subsequent hacks and failures, one might imagine that if a popular contract with a similar threshold of Ether was breached, it might call them into action at the blockchain level once again. In the case of the DAO, Ethereum's futures switch to proof of stake was cited as justification for rolling back the exploit, which would have granted a presumably hostile actor a large share of the outstanding Ether, and hence a significant role in the future of the network under a proof-of-stake regime. Other less critical bugs or exploits have not met the seriousness threshold to merit a rollback, even when those affected lobbies Ethereum leadership. While the post-DAO hard fork of Ethereum is generally seen as a prudent move, it constituted on strict terms a violation of property rights and brought into question the settlement assurances of the blockchain. On Ethereum, there is no legal adjudication. Knowledge of private key is tantamount to ownership. Thus, under the protocol rules, the entity that exploited the DAO was the rightful owner of the Ether in question, and those rules were overridden to bail out depositors in the DAO contract. Such interventions could be helpful for obtaining recourse when catastrophic failures or bugs occur, but they also introduce subjectivity and arbitrariness into the settlement process. Proof of work consensus failures. More straightforwardly, smaller blockchains can be exploited when miners believe they are not sufficiently compensated. When miners gain sufficient hash power, they can coordinate consensus attacks, of which a subset is known as reorganization attacks or 51% attacks. These attacks consist of exploits in which validators employ their privileged access to transaction ordering to extract some value from the blockchain. These consensus attacks generally take place on proof-of-work blockchains, because such blockchains provide relatively low compensation thresholds to miners, making validator attacks more economically plausible. Often, these attacks occur in the presence of general-purpose computing hardware, which can be borrowed or rented. As an example, in early 2021, validators on the Verge blockchain rolled back 200 days of data, effectively invalidating months of transactions. These reorganizations of blocks can be used to omit certain transactions that were presumed settled, including deposits credited by an exchange. Thus, reorganizations are often tools for the fraudulently misleading merchants or crypto exchanges into believing that there is a valid deposit, which is then ultimately excluded from the ledger. Indeed, both the Ethereum Classic and the Bitcoin Gold blockchains have suffered multiple such protocol-level attacks, some of which were used to successfully defraud crypto exchanges. DeFi applications rely on the base layer blockchains to settle and clearly transactions, so the application stack is compromised when the underlying blockchain malfunctions. Both Ethereum and Bitcoin currently rely on proof of work, so they are theoretically exposed to these kinds of attacks. However, Ethereum and Bitcoin offer incredibly large security budgets, making an attack extremely expensive and likely impractical. Additionally, Bitcoin is mined with Bitcoin-focused hardware, known as ASICs, that cannot be repurposed for use in general computing or for the most other crypto networks. So miners would have less incentive to attack the Bitcoin blockchain and destroy what gives their Bitcoin ASICs value. Moreover, as Bitcoin ASICs are essentially the physical embodiment of future cash flows in Bitcoin over the ASIC's useful lifetime, miners are strongly incentivized to support the long-term value of the Bitcoin blockchain. Similarly, a large share of the value of the high-end graphics processing units, GPUs, used to mine Ether derives from the value of Ether itself. So miners attacking the Ethereum blockchain would be deprecating their own equipment in doing so. For blockchains such as Bitcoin, with a capped issuance, questions remain over the long-run viability of proof of work when Bitcoin becomes a network based solely on transaction fees. Various studies have identified the potential instability or insufficiency of a fee-based proof-of-work market environment. Miner Extractable Value, MEV. Nevertheless, reorganizations of blocks or 51% attacks are only one class of a broader set of validator-based exploitations known as Miner Extractable Value, or MEV. First introduced by researchers Diane et al. In 2019, the term MEV refers to the value that validators, as in the entities assembling transactions into blocks, or third parties can extract from transacting users by front-running them and selectively reordering transactions. MEV is made possible due to the innate transparency of the Ethereum transactions, their utility in on-chain exchanges, and the possibility of gaining priority by outbidding other users, or simply reordering transactions if you are the miner. MEV can be thought of as somewhat analogous to a hedge fund paying for order flow in order to trade against uninformed or retail flow. As the complexity of transactions increases, more front-running and risk-free arbitrage opportunities emerge. Thus, the vast majority of observed MEV takes place on Ethereum and largely relates to transactions occurring on automated market maker exchanges, where users can frictionlessly swap assets by engaging with pools of liquidity. AMMs offer users guaranteed liquidity on exchanges, albeit at the potential cost of efficient execution. According to Flashbots.net, a lower bound of $369 million worth of MEV has been harvested by validators or arbitrage bots since January 2020. This represents a net drag on users, which end up financing the MEV through slippage on their trades. Effectively, MEV can be understood as similar to a rake at a casino. Most researchers consider MEV endemic to blockchains like Ethereum, where transactions on decentralized exchanges or DEXs are transparent. If the parties engaged in front-running materially degrades users' transactional experience, the logic of transparent DeFi could be called into question. While some analysts contend that MEV represents an alternative subsidy to miners or validators, permitting blockchains to function at a lower level of issuance or fees, researchers Kin, Zuo, and Jervis have highlighted how aggressive MEV poses a threat to consensus. In their estimate, quote, "The biggest danger lies in the willingness of miners to extract and compete over MEV, which would increase the stale block rate and consequently aggravate the risks of double spending and selfish mining." End quote. Stale blocks and double spending reduce the predictability of the base layer and introduce uncertainty into settlement finality, impairing the assurances of crypto economic protocols. In an attempt to mitigate the protocol-level harms of MEV, Ethereum developers have proposed an Ethereum node client that codifies MEV and allows miners to auction off their rights to reorder transactions within a block, delegating the process of finding risk-free arbitrage to specialized third parties. This would turn MEV into an explicit part of the compensation structure for miners, reduce the protocol instability caused by the current adversarial state of MEV, and increase fairness in mining by allowing less sophisticated miners to cheaply monetize MEV. Other researchers, unconvinced by the codification of MEV, have proposed alternative solutions, such as fair transaction ordering or the encryption of transactions between the broadcast and execution stage. Due to the downsides associated with broadcasting transactions to a global mempool, privately mined transactions are becoming more popular. Effectively, this involves routing transactional data to miners directly in a manner reminiscent of dark pools. At the time of writing, over 75,000 Ethereum transactions have been sent directly to miners rather than being broadcast to the network in the conventional manner. At present, MEV appears to be a fundamental feature of data-rich blockchains that facilitate transparent on-chain exchange. Transparent queuing systems for pending transactions combined with the ability to outbid and displace a transaction inevitably yields exploitation opportunities. Unlike a retail brokerage like Robinhood selling customer order flow, MEV extractors are not obliged to the individuals they are arbitraging. Thus, there are no natural limits to the exploitation of end users through MEV. Validator cartels. Non-proof-of-work blockchains are not immune to protocol interventions at the validator level. One popular alternative to proof-of-work is known as proof-of-stake, where the power to assemble transactions into blocks, and in some cases exert political power over the network, is a function of one's share of all protocol tokens held. In certain network arrangements, the number of validator slots is fixed, creating strong incentives to consolidate power and cartelize. Because validators are typically rewarded with fees or new issuance, the consolidation of power through vote buying has been observed in proof-of-stake blockchains, such as EOS. Such measures allow validators to consolidate power, granting them eventual control over which transactions can be included in the final ledger. If validators are fixed and free market competition for block space is snuffed out, the censor resistance of the protocol properties would be at risk. Since DeFi is built on the assumption that the underlying financial infrastructure is neutral and unstoppable, such concentration of power in validators is a significant threat. An instance of validator collusion can be found on the STEM network, where STEM coins owned by the blockchain entrepreneur Justin Sun were frozen after validators suspected his intentions to co-opt the network. Quote, specifically, the witnesses were able to unilaterally lock out Sun after a simple majority vote passed 19-1. They had orchestrated the plan in a private Slack group, ran a software upgrade on the blockchain, and froze the Tron Foundation CEO's funds. End quote. In this case, Sun fought back by enlisting custodial exchanges, which held large fractions of the supply of STEM on behalf of users, to employ users' deposits to vote in his favor and overrule the actions of the validators. This illustrates how large cryptocurrency custodians and cryptocurrency deposit-taking institutions can take on vital roles as kingmakers in the proof-of-stake systems. With Ethereum, the largest DeFi platform slated to transition to proof-of-stake, custodians hold large quantities of Ether, will have outsized control over the network, and may be able to materially influence network outcomes. Thus far, crypto exchanges have generally not recused themselves from protocol interventions. Effectively, they act as principals rather than as agents when deploying client funds for on-chain votes. Inflation bugs. Other, more catastrophic protocol vulnerabilities abound, which can affect the DeFi applications built on top of them. One such risk is posed by inflation bugs, which inflate the supply of coins ahead of a pre-agreed or expected schedule. As coins are issued and begin to circulate, recipients of these new coins have a strong disincentive to roll back the chain and undo the unexpected inflation. Inflation bugs are frequent and have affected many of the largest blockchain protocols, and in some cases were not fully remediated. Blockchains that have witnessed material inflation bugs that were exploited include Bitcoin, Bitcoin Private, and Stellar, as well as many other less notable cases. Other networks that have faced potential inflation bugs but were not known to have been exploited include Zcash and Monero, a particularly insidious threat when privacy-focused chains are concerned, as the inflation is harder to detect on more opaque blockchains. Another Bitcoin vulnerability patched in 2018 could have been used to create unexpected inflation but was not exploited. Since DeFi protocols are highly automated, run continuously, and operate with minimal or in some cases no human oversight, inflation bugs on the underlying native protocols can significantly destabilize DeFi applications. Inflation bugs are among the most severe threats that blockchains face. and remediation often requires halting or rolling back the blockchain, which would impair the assurances of any smart contracts relying on the underlying blockchain. Recently, the DeFi-focused blockchain Kava was halted to address a bug which was significantly overpaying planned distributions, known as yield farming. That ends the section on the risks to DeFi from the underlying blockchain. Next up is smart contract-based risks. A. Technical vulnerabilities of smart contracts. Smart contracts, as described earlier, are not legal contracts. Instead, they are code that automates actions. These actions could be parts of native cryptocurrencies on public blockchains, such as Bitcoin and Ether, which can be understood as synthetic commodity money. They are not guaranteed or backed by any third party and are not redeemable for anything, including fiat currency. Instead, they serve as access tokens to the Bitcoin and Ethereum networks, respectively, and as a form of collateral and transactional medium within these networks. For these native cryptocurrencies, it is fully possible to destroy, permanently immobilize, or render them unspendable. While some exploits represent such an existing existential threat to the network that they have been remediated with recourse to social consensus, the vast majority of exploits do not reach a critical threshold of importance. Therefore, users who interact with faulty smart contracts could risk losing all of their coins and are generally unable to obtain bailouts or recourse. Perhaps the largest unremediated failure of a smart contract was the immobilization of 513,774 Ether held in a multi-sig wallet written by Parity, an Ethereum development organization. Common multi-sig setups involve 2 of 3 or 3 of 5 schemes. The former would allow outputs to be spent if valid signatures from any 2 of 3 predetermined keys were provided. The multi-sig wallets were exploited by an anonymous user who triggered a function in a smart contract, effectively causing each wallet to self-destruct, irredeemably immobilizing the Ether contained within. The newly locked Ether, equivalent to 0.52% of all the Ether in circulation at the time, was worth $174 million at the time of the hack and $1.175 billion at the time of writing. Because Ethereum and other smart contract-enabled blockchains are more expensive and permit more complex transactional logic, such failures are unavoidable. In this case, the faulty multisig wallets were produced by an organization run by Gavin Wood, one of the co-founders of Ethereum and the inventor of Solidity, Ethereum's dedicated programming language. The difficulty of writing a truly safe multi-sig contract illustrates the inherent risk involved in transacting with digital bearer assets on expensive and hence vulnerability-prone base layers. Moving beyond custodial risks, more complex interactions between smart contracts as required by DeFi protocols can introduce additional scope for potential vulnerabilities. DeFi is rife with the purely technical vulnerabilities owing to the complexity of interactive blockchain-based smart contracts and the difficulty of anticipating complete edge cases before deploying code. Smart contracts, once deployed, are cumbersome to upgrade, creating significant initial burdens on developers. In the case of certain irrevocable smart contracts like Uniswap, developers have no ability to take down a smart contract once it's deployed. Upgrading such a smart contract would be a matter of deploying an alternative and persuading users to use it. As long as the underlying Ethereum blockchain remains intact, certain classes of smart contracts will remain operable, regardless of administrator or user behavior. In certain other types of smart contracts, administrators can insert provisions into the code of their smart contracts so they can be upgraded, terminated, or deprecated. These code provisions grant developers additional discretion and recourse if there are bugs in deployed contracts. However, this has the externality problems of potentially making administrators responsible for user funds, as well as making the entities controlling the administrative keys a target for attackers. Technical exploits are common. Werner in 2021 identified 21 such attacks on DeFi protocols between February to December of 2020, costing users an aggregate of $144.3 million, although in some cases funds were returned by attackers. These exploits are varied in their approach, taking advantage of re-entrancy bugs, transaction sandwiches, logical bugs, and governance. In each case, however, attackers take advantage of the properties of DeFi, predictable algorithms managing large pools of capital with limited human oversight, built on blockchain rails. The rigidity of certain DeFi primitives, like automated market makers, can facilitate many of these attacks. The natively on-chain nature of the collateral in the case of Ether grants attackers the ability to withdraw their profits with no recourse. When the captured tokens include stablecoins or other assets that are the liability of a third party, the tokens can be frozen. B. Oracle attacks. One class of vulnerabilities deserving special attention relates to failures resulting from oracles. In DeFi, oracles are service providers that provide outside information to a smart contract. The most common usage of oracles is to transmit market prices, drawn from one or many exchanges, to a DeFi protocol that relies on outside pricing information. For example, protocols employing tokens as collateral would need to know the value in standard terms like USD of the pledged tokens and employ smart contracts that consume oracle-provided market information. A number of DeFi protocols rely on oracles, and the price inputs are critical to trigger liquidations, deleveraging, margin calls, and other forms of automated collateral management. Consequently, manipulation of oracles can be catastrophic for these protocols. It would be somewhat comparable to what would happen in traditional finance if Bloomberg were hacked and data were manipulated or could no longer be trusted. Due to the sensitivity of these protocols to deviations between the spot price of an asset and an index price, opening up riskless arbitrage opportunities, so-called oracle attacks are among the most popular means of attack. Similar to strategies that involve manipulating the spot reference price for a derivative, oracle attacks involve manipulating the market price of collateral referenced by a DeFi protocol in order to create riskless arbitrage or to trigger liquidations. As Liu pointed out in 2020, Oracle introduces risks in a number of ways. Their mechanics are opaque and unaccountable, they introduce critical nexuses of trust and dependency into DeFi, and malicious oracles can cause catastrophic harm. The authors find repeated operational failures in the methodological approaches to aggregating data across multiple exchange venues, introducing operational risks, and producing poor outputs. As pointed out by Werner, market dislocations at spot exchanges feed into oracles and affect DeFi systems built atop these price feeds. When the thinly traded stablecoin DAI briefly traded at $1.30, whilst it is typically pegged to $1 on Coinbase, this unnaturally high premium was fed into the Compound protocol's price feed, leading Compound to automatically decree that a number of accounts were in default and programmatically deleverage and liquidate $88 million worth of collateral. These wrongful liquidations occurred because of poor index construction on the part of Compound, combined with the false assumption that DAI would not trade at a significant premium on referenced markets. C. Excessive leverage. Smart contract-based flash loans. Certain idiosyncratic features of DeFi introduce attack vectors that are entirely novel. Among these is the flash loan concept. Proposed in 2020 by DeFi lender Aave, the flash loan is an unsecured loan permitting a borrower to access an unlimited amount of liquidity with a very low interest rate. The catch is that the loan must be paid back within the same transaction that it is taken out. Since DeFi applications give rise to frequent arbitrage opportunities, such short-term loans allow individual parties with limited access to capital to obtain leverage and take advantage of mispricings, as long as transactions can be executed automatically, as in simultaneously. A transaction on Ethereum can invoke many contracts synchronously. Flash loans are a useful tool in inter-contract arbitrage, as described by Wang. Flash loans dramatically reduce the barriers to entry for potential attackers, while increasing their leverage, and hence the financial impact of their attacks on DeFi. Ever since their introduction, flash loans have become increasingly prevalent in DeFi attacks. Cao identified 9 separate instances between February and December 2020 in which attackers successfully siphoned a total of $49.5 million from DeFi protocols through flash loan assistant exploits. The largest of these, the Harvest attack in October of 2020 saw the attackers extract $26 million from Harvest using the Curve and Uniswap protocols, while relying on a flash loan from Uniswap v2. While flash loans could be a helpful tool, they can be misused to dramatically empower would-be attackers by making trial and error costs cheap and granting near unlimited leverage, provided that transactions can be constructed so that the loan is paid back instantly. Other governance and regulatory risks. A. Administrative key abuse. Many DeFi protocols retain the discretionary option for administrative teams or other entities to shut them down, upgrade them, pause the contract, and in some cases drain user funds. There are a few exceptions, like Uniswap, which simply exists as deployed code on Ethereum that users can freely choose to interact with. The Uniswap contracts themselves cannot be paused by the developer team. The vast majority of protocols, however, do retain some form of control feature, including kill switches. In some cases, critical smart contract decisions are delegated to the community of token holders, although in practice, this collapses back to granting decision-making power to a small number of insiders and backers, as voting weight is typically proportional to one's share of tokens held. Additionally, since tokens are generally available on the open market, which trades 24/7 on DEXs with no identity verification, an attacker could freely purchase or borrow tokens in order to influence a token holder vote. Thus, many projects for which token holder votes can influence the contract choose to retain de facto control by directly limiting the free float of tokens. As the St. Louis Fed notes regarding admin keys, quote, "If the key holders do not create or store their keys securely, malicious third parties could get their hands on these keys and compromise the smart contract. Alternatively, the core team members themselves may be malicious or corrupted by significant monetary incentives." End quote. A common practice in mitigating admin key risks is granting a consortium of delegates control over critical smart contract decisions by distributing power over key-related decisions into a multi-sig setup. Some other controls exist, including enforced time locks on key-related decisions, as in the case with Yearn, or by granting signatories a limited pre-specified set of powers, such as done by synthetics. The existence of admin keys in the majority of high-profile active DeFi projects raises a number of risks. Chiefly, these include key loss, insider theft of deposits, theft through extortion or hacks from outside parties, and regulatory pressures. In many setups, including that of synthetics, contracts can be unilaterally frozen for a period by insiders as a precautionary rapid response mechanism in the case of a hack or exploit. However, while merely pausing a contract does limited harm, it could adversely affect liquidity. Ultimately, assets held in contracts mediated by admin keys should be understood as custodial rather than wholly sovereign interactions between users and a protocol. Adding more signatories to a multi-sig setup simply means that users' deposits are held in the custody of a consortium of insiders rather than by one entity. Research into the presence of admin keys is sparse because practices are constantly evolving. While major DeFi projects have made efforts to mitigate key man risk and eliminate critical points of centralization with regards to admin keys, independent researchers have nevertheless identified DeFi applications where administrators have unilateral control over user funds. Today, the major DeFi protocols Synthetics, Yearn, Dharma, SushiSwap, Badger, Harvest, and Ren, containing user deposits of $10.5 billion collectively as of April 12, 2021, maintain admin keys, enabling a discretionary freeze of user funds. While the power vested in admin keys varies, in some cases, anonymous individuals retain the right to siphon all liquidity allocated to contracts they administer. Notably, the anonymous admin behind Harvest Finance, which once held over $1 billion in user deposits in its smart contract, can drain user funds encumbered only by a 12-hour time lock. Projects like these, while deployed on public chains, are dubiously decentralized, as they are functionally indistinguishable from centralized asset-taking institutions. Some efforts exist to quantify and monitor the risks that users face from the existence of admin keys. The DeFi Watch project, for instance, is a crowdsourced community project that monitors the presence of admin keys in DeFi systems and evaluates their trustlessness. Disclosure of administrative powers by core teams, token holders, and other entities has been poor. For most projects, the scope of powers afforded by admin keys remains opaque, as the developers creating these contracts seek to avoid the perception that they have control over user balances. B. Governance attacks. As more blockchain-based projects aspire to transform corporate business models by undertaking a decentralized governance model, they introduce new risks. In practice, development teams have been sluggish to delegate genuine decision-making power over development decisions and system parameters for keys, which has meant that few governance attacks have been observed thus far. However, should regulators see through the veil of decentralization erected to obfuscate the true nexuses of control in DeFi protocols, they would see that certain development teams have sought to distribute governance power to holders of governance tokens. These governance tokens endow their holders with and often a claim, albeit frequently a diffuse one, on cash flows or fees generated by these systems, as voting power over system parameters. Typically, these have been managed limited experiences whereby governance token holders could not vote to, for instance, fire the core development team, or redirect funding from the core corporate entity or nonprofit managing of the system. As token holders assert themselves, however, and gain the capacity to be more activist investors, new classes of governance attacks emerge. Activists could elect to exploit DeFi systems to benefit token holders at the expense of the users of the systems. For example, one theoretical attack, according to Jeng, would be for a governance attacker to gain control of the MakerDAO system and siphon off capital from the system. As governance tokens become more available for short-term liquidity, particularly through flash loans discussed above, activists can more easily exploit governance tokens to manipulate system parameters. After interacting with the Jeng-led research team, MakerDAO noted the potential usage of flash loans to influence the outcome of governance votes, and the MakerDAO community consequently voted on subsequent changes to the system's risk parameters. As noted with the STEM Hive case study, tokens held by exchanges on behalf of users have been employed to influence governance outcomes, in some cases against the wishes of these users. Large caches of governance-laden tokens sitting at exchanges could influence them to accept bribes in order to vote favorably on specific proposals, or simply could be borrowed on an extremely short-term basis to swing a governance vote. For instance, exchanges could naturally look to monetize user tokens held on deposit via flash loans, because the flash loans do not impair their ability to process withdrawals, because the term of flash loans is literally 0. Meanwhile, the borrower only needs to hold tokens for the duration of an on-chain vote in order to influence the outcome. C. Tainted liquidity. At its core, DeFi envisions novel ways to undertake financial transactions. The cryptographic nature of digital assets permits increasingly sophisticated and intricate schemes for managing custody and transactional workflows. Bitcoin, for instance, offers a native multi-sig functionality, whereby transactions can specify advanced conditions required for an output to be spent. As of the time of writing, there exists a lower bound of 900,000 BTC held in known multi-sig setups. Thus, a novel class has emerged of custodians that maintain keys as a service, allowing individuals and entities engaging in self-custody to take advantage of the sovereign nature of holding one's keys while maintaining the possibility of recourse in the case of key loss. A common collaborative custody model involves a client holding a key in a hot wallet, a third-party custodian holding one key, and a third key held for recovery, with 2 keys required for a valid spend. Engaging in collaborative blockchain transactions, however, can cause custodians to incur liability from regulators such as the Office of Foreign Asset Control. Indeed, BitGo, which provides key management as a service in multi-sig transactions, was sanctioned by OFAC for providing such services to clients in OFAC sanctions in Crimea, Cuba, Iran, Sudan, and Syria. Bitcoin payment processor BitPay also settled charges with OFAC. Additionally, the Financial Action Task Force, FATF, recently clarified in their recently revised draft guidance on virtual assets that parties administering keys in a multi-sig setup risk being considered virtual asset service providers, which would subject these parties to surveillance and disclosure obligations, as well as to travel rule compliance requirements. According to Coin Center, the FATF draft guidance breaks with policy precedent from the Financial Crimes Enforcement Network, FinCEN, which considers only persons with independent control over customer funds are treated as regulated money transmitters. The revised FATF draft guidance would dramatically increase the scope of covered parties. DeFi in its current form is largely incompatible with such regulations, since most decentralized contracts do not require any user identification beyond a valid blockchain address. There is virtually no emphasis on centralized compliance. Products facilitating on-chain swaps like Uniswap are simply blockchain contracts that permit users to collaboratively pool funds and make trades with no central intermediary. The nature of these peer-to-peer pools systems is such that these contracts cannot meaningfully exclude any entity looking to participate in the pooling, which is open and freely participatory by definition. Uniswap in particular relies on liquidity providers that contribute assets to a pool in exchange for fees. These are not designated entities. Anyone can be a liquidity provider if they contribute assets to the pool. At the time of writing, Uniswap v2 boasted 84,000 active liquidity providers, with 5,400 liquidity providers active in the most popular pair, Uni and Wrapped ETH. If some tainted liquidity, for instance, emanating from an OFAC-sanctioned party or an illicit source were to enter a Uniswap pool, regular users would effectively be undertaking a financial relationship with these prohibited parties. As currently deployed, the smart contract has no means to whitelist users or permission them a priori. The very nature of decentralized finance on public blockchains like Ethereum is to facilitate permissionless exchange. But this open access is generally incompatible with anti-money laundering and combating the financing of terrorism regulations as currently implemented in the US. D. Pseudo-equities, regulatory uncertainty. Transactions that involve lending, investment trading, and derivative exposure are regulated in traditional financial markets through the registration, licensing, and examination of intermediaries that broker, custody, clear, or otherwise facilitate such transactions. In DeFi, intermediaries are largely excluded in favor of transparent code, presenting regulators and policymakers with complicated decisions as to how to assess transactions, often bilateral, for which no clearly identified party may be regulated. These important issues regarding the regulatory uncertainty of the underlying commercial transactions that are conducted through DeFi protocols are beyond the scope of this paper. This subsection, however, examines more specifically so-called pseudo-equities and their inherent regulatory risks. Despite considerable regulatory risks of issuing pseudo-equity tokens with little regard for the requirements of securities law, many DeFi protocols are administered by the US-based firms or nonprofits. In many cases, these entities finance themselves through the issuance of a token that represents a claim on some cash flow produced by the system. These tokens have proven to be a meaningful financing vehicle for developing DeFi protocols. At the time of writing, the aggregate market capitalization of tokens in the decentralized finance space is $85 billion, with Uniswap, Synthetics, and Compound collectively having taken in $12.29 billion in allocated collateral, being the largest pseudo-equity tokens. Many of these DeFi tokens endow token holders with some rudimentary governance rights, as well as either implicit or direct claims on cash flows generated through DeFi protocols. None of these pseudo-equity tokens backstopping DeFi are registered as securities, circulating instead on decentralized financial infrastructure like Uniswap. If securities regulators deem such pseudo-equity tokens to be unregistered securities, and pursue not only their issuers and promoters, but also the venues upon which they trade, the financing and governance models of these DeFi protocols would be significantly impaired. Additionally, numerous DeFi protocols subsidize their liquidity by issuing new units of pseudo-equity to end users. If these tokens were to be delisted and their liquidity and value suffered losses, the utility of these subsidized protocols would decline. These token incentives built into DeFi protocols are the equivalent of Uber compensating drivers for each mile driven with incremental units of Uber equity. As an example, the compensation for supplying the stablecoin USDC to the money market protocol Compound is 6.71% annualized at the time of writing, supplemented by a 2.15 annualized payout in comp terms to suppliers of USDC. The combination of the two is described as the net rate for the USDC by Compound. If these incentives were to expire or be withdrawn, interest rates would look significantly less attractive, reducing the incentive for liquidity providers to put their capital at risk. Virtually all DeFi protocols require oversight, bug remediation, technical and economic audits, governance, stewardship, and leadership and direction from these administrative entities. Even if there are no corporations or firms officially underwriting these decentralized protocols, virtually all of these protocols have an entity, whether codified or not, effectively managing the protocol. The elimination of the pseudo-equity token as a viable financing mechanism would significantly impair the industry's ability to operate. It is possible, however, that corporations could create the majority of decentralized finance contracts and monetize them without the use of a token by directly charging rents for usage of the DeFi contract, or that anonymous developers could deploy these protocols on the blockchain. 5. Challenges associated with scalability. Scalability, the general process whereby public blockchains grow to handle an economically meaningful volume of activity and more transactional data without compromising their assurances, is held as one of the chief difficulties facing blockchains today. Adding more data to the final ledger trades off against the computational difficulty of operating a full node and staying current on the ledger. While no silver bullet solution to scalability of blockchain exists, since the basic security model of blockchain requires that all participants store a full copy of the state, various improvements have been proposed. Approaches such as Bitcoin's Lightning Network envision a network of payments channels with only periodic final settlement to the Bitcoin layer itself. Sidechains immobilize Bitcoins or other native units and create a subledger whereby claims on those Bitcoins can circulate frictionlessly, effectively creating a new transactional space. Sharding splits the state of the blockchain into parts, with nodes finding consensus on a subset of the final state periodically reconciling with each other. More creatively, rollups bundle transactions, moving computation on-chain, but retaining final transaction data on-chain. The validity of these transactions is assured through zero-knowledge proofs or mechanism known as fraud proofs. The commonality around all these approaches is transactional parsimony, or the reduction of a transaction into as few final bytes as possible, since the cost associated with storing and processing transactional data is the chief externality of blockchain transactions. Unless radically new models for public blockchains are developed, the problem of scalability will be an inherent constraint, as it follows naturally from the requirements that node must ingest and verify the global state in order to become full participants on the ledger. Additionally, these approaches all generally aim to defer final settlement by distinguishing a payment or financial message and the settlement of that message or bundle of transactions. This deferred settlement mechanism will be familiar to anyone with knowledge of established payment systems, but public blockchains have only just begun to explore their implications. As mentioned, public blockchains in their current form are effectively deterministic, single-state environments in which each peer must process each and every transaction in order to stay in sync in a trustless manner with the blockchain's current state. Both Bitcoin and Ethereum have committed to operational limits on the most data throughput that either system can handle, with Ethereum adopting a looser constraint. These limits roughly correlate with the number of transactions that consumer hardware can meaningfully process without falling behind. In order to prioritize transactions, both systems employ fees. Naturally, some classes of users are more willing to bear fees than others, with fee sensitivity generally being a function of the perceived importance of a transaction. The consequence of this approach means that in their current format, heterogeneous demand requires that some applications are naturally priced out at any given time. Applications of Ethereum are varied, running the gamut from using stablecoins for remittances to operating decentralized organizations to minting non-fungible tokens that represent unique pieces of artwork, to financial use cases like obtaining programmatic leverage. Since all of these applications are competing for the same finite pool of block space, a burst of adoption for one use case can degrade the experience of using another. High fees have the effect of pricing out similar, smaller transacting parties who might deem an operation uneconomical if fees hit a certain threshold. Due to relatively inelastic block space combined with volatile demand for blockchain resources, fees are highly volatile. For instance, on February 23, 2021, mean per transaction Ethereum fees reached $38, while mean Bitcoin fees reached the equivalent of $25. For comparison, in 2019, Bitcoin and Ethereum per transaction fees averaged the equivalent of only $1.24 and 13 cents respectively. In addition to the general drag that fees introduce on transactional usage, blockchain congestion can facilitate specific attacks against DeFi protocols, which sometimes need to execute transaction within a specific period. On March 12, 2020, for instance, the MakerDAO system became insolvent when third-party participants, known as keepers, were able to bid $0 during on-chain liquidations of Ether, even though the ETH market price was fluctuating between $80 and $120 that day. In addition, the Ethereum blockchain was experiencing significant lags during which transactions were not processed in time due to high fees, precluding other keepers from participating in the $0 bidder auctions. This series of events affected liquidations of roughly $8 million of collateral backing users' debt positions in the MakerDAO system, leaving the DAI stablecoin under-collateralized by $4.5 million. Additionally, as fees rise on blockchains, they price out certain classes of activity, especially more computationally expensive actions, particularly for blockchains like Ethereum, where the cost to transact is a function of computational demand. This systematically prices out users with smaller balances and has the net effect of trapping funds held in accounts, stranding those assets. As fees rise on the base layer, retail users can no longer economically engage in DeFi, operating on the base layer, affecting liquidity in decentralized exchanges. In Bitcoin, a negative feedback loop between transactional usage and fees was evident in 2017 and 2018, indicating that fees not only adversely affect users' affinity to transact, but they do so in an inherently unstable way, without finding equilibrium. DeFi protocols depend critically on seamless interoperability as well as on composability. Jeng stressed the importance of composability on these systems. Quote, assets that are created in Maker, for example, can be used as collateral in other protocols such as Compound, DYDX, or in liquidity pools on Uniswap, thus mitigating the impact of base layer fees by creating subledgers or deferred settlement processes like sidechains, rollups, or sharding does little to solve the problem at its core. Deferring settlement introduces efficiencies by engaging in periodic reconciliation with the base layer itself. However, DeFi as currently envisioned depends on funds being available on the base layer and contracts being able to seamlessly communicate and refer to each other. Thus, standard approaches to scaling appear to compromise the desirable qualities of DeFi and do not represent a panacea to the free drag. It remains to be seen whether the standard approach to scaling blockchains, effectively mimicking the layered approach that characterizes established payment systems, can be made consistent with the desirable qualities of blockchains that distinguish themselves from these systems. If they cannot, then real estate on the base layer of blockchains with capped throughput will be reserved only for well-capitalized parties, which are able to outbid smaller users. Conclusion: no free lunch. The risks described in this chapter do not seek to provide a comprehensive list, but to help readers conceptually understand the drivers behind the risks inherent in DeFi. Many of the risks described above stem from the decentralized nature of blockchains, the goal of automating the delivery of financial services and reducing human dependencies also has the congruent effect of reducing oversight and control. Disintermediating traditional intermediaries reduces high fees and entry friction, but also creates new opportunities for new types of intermediaries. These new types of intermediaries require the sufficient economic incentives, and thus could be potentially more costly and risky than the monopoly rents extracted by today's centralized intermediaries. Ultimately, this new host of intermediaries in a decentralized financial ecosystem could stymie the drive towards the twin goals of democratizing financial services, lowering cost, and improving access. External dependencies on traditional finance, namely banks, is another important source of risk, as well as transmission channel for risk. Although one of the goals of DeFi is to create a new kind of financial system without traditional intermediaries, the irony is that as DeFi struggles to make itself more useful in the real world, its dependency on the established financial system grows. Its reliance on traditional finance is not only a source of risk, but can potentially serve as a transmission channel for risks between traditional financial and DeFi systems. DeFi leveraging stablecoins backed by fiat or other financial liabilities is an excellent example of this type of risk. Another dependency is that the crypto industry still needs to bank with commercial banks in order to conduct the cash legs of their transactions. DeFi is developing in a direction different from originally intended, and thus it is coming full circle. The tools exist to wall off DeFi from the financial system, such as running everything on native tokens, DAI, or ETH for instance. However, the opposite is occurring. Relying on commercial banks for stablecoins is convenient and serves business needs. Wholly new risks are introduced by DeFi, stemming from the reliance on open protocols and the fact that the underlying infrastructure is unowned. Removing the back office and human oversight results in many efficiencies, but they also introduce risks. Thus, it is up to the end user to contract administrator to monitor the risk of the protocols themselves, and many would not want the burden. These risks are amplified when financial primitives collide with automated, hard-to-intervene contracts. Here is where all the chaos in DeFi is really from. Systems that are built to be scalable and automated, but that are underspecified or not understood by their creators. In sum, blockchain technologies bring many benefits, but the tools or processes used to disintermediate or gain efficiency also have costs in recourse, reversibility, risk management, etc. This is the paradox of DeFi. In spite of this paradox, DeFi is achieving something truly novel. It is facilitating the business model experimentation and evolution in a very short time frame. While our traditional financial system has evolved over centuries to reach our current institutional arrangements, as in banks, financial markets, market participants, different types of regulation, each in response to past crises and missteps, DeFi is allowing for significantly more rapid institutional innovation and trial and error experimentation. There is a lot of error at the moment, such as speculative bubbles, fraud, and governance issues. But those innovations that persist over several years in such a fast-moving environment could be much more robust. As DeFi becomes more economically relevant, financial stability risks in DeFi could come not only from the links with the traditional financial sector, but also from the risks within the DeFi sector itself. More research is needed to study how shocks in the DeFi sector can impact the greater financial system and the real economy. There is a greater need than ever to research this understudied but increasingly important area to help provide a better understanding of the evolution of financial services and the risks inherent in DeFi for industry regulators and policy makers. Okay, that is an end to DeFi Protocol Risks, The Paradox of DeFi by Nick Carter and Linda Jeng. And I'm here a little bit sick towards the end of it, and so my voice is a little bit scratchy, and so this was a harder read than a lot of the other ones. And in terms of my take here at the end, the truth is that I really agree with most of this paper. I think DeFi, in many ways, is like the Wild West. And during the 1830s, 40s, 50s, and 60s, when the United States in particular had an era of free banking and migration west, there was no central authority. There was no central law in many places. And that era, known as the Wild, Wild West, really was. And there was lots of fraud, and there was lots of entrepreneurship and innovation and mistakes. And I think that DeFi and crypto in general, in many ways, is very similar. We're at the frontier. The bankless duo say this all the time. We're at the frontier. We're going west. It's not meant for everyone, but we're glad to have you along the journey. And I really agree with that sentiment. We are heading west. This is the frontier. The protocols that have been in place and these DeFi companies and basically everything we're working on in the blockchain hasn't had the time to harden. Even Bitcoin, that has the greatest Lindy effect, had a bug that was discovered in 2018 that not many people know about. And that's 10 years after the Bitcoin white paper. 9, but 10. And that's just like right now. That's 3 or 4 years ago. And that's Bitcoin, the simplest protocol, the one that most eyes have been on. And so if we think about the other protocols and smart contracts and blockchains that are being built and have been built, we're really only at the beginning. And none of these have had the time to harden properly. And I'm sure that there will be more bugs, more exploits, more fuck-ups, more screw-ups. And this paper was written last year. And since then, over the past 6 months, we've seen basically every single kind of attack that's been outlined here. Governance attacks and flash loan attacks, multi-sig breaches with the Ronin sidechain for Axie Infinity recently, $630 million just by, a 5 of 9 multi-sig being exploited, not by anything hacky, just by social hacking. And so all of these protocols, it's true, they're not decentralized in the same way as Ethereum or Bitcoin are, and they can be hacked and there are bugs. But these problems are not to detract from what's going on in DeFi. And I think that's something that we have to keep in mind. There's a difference in time horizon. The short-term time horizon, it's buyer beware. There's lots of risks, and you have to really audit the contracts and the protocols you are going to put your money in. You have to ask yourself, can administrators deal with this? What happens if the oracle that it's relying on gets hacked, attacked, spoofed, goes dead? Anything like that. What happens when the SEC starts cracking down? There are all kinds of risk vectors for DeFi. And this paper outlines 5 of them. There are more, actually. And when you put your money in a protocol, in a project, or anything like that, you have to be considering these questions. But that's the short-term time horizon. I think the long-term time horizon is that over the next 5-10 years, these protocols will be hardened. And just like today, there are almost no bank thefts because we figured out how to put a system around that it's just not worthwhile for most robbers to do it. We'll figure that out as well in most of these protocols. And the smart contracts that work, that survive, that aren't hacked, those ones will be forked, and those ones will be copied, and those ones will draw liquidity. And we will be in a place where the DeFi protocols are serving as a base layer for decentralized finance, for permissionless, more democratized, less middlemen, lower transaction fees, greater financial freedom. And that's the great promise here. I just finished reading a book called The Ascent of Money about the history of money, and the amount of human fuck-ups throughout history are incredible. And we'll suffer them more here, but at least we won't suffer from one major human fuck-up, which is racism and bias, which has been part of every single financial decision for the past 4,000 years. The book brings this case of during the 1960s and 70s, the United States passed regulation to increase home ownership, but really only for whites. For African Americans, interest rates were still too high because white bankers just didn't see them as creditworthy, even if they had literally the same statistics as a white person. And DeFi eliminates that because it's just code. There is no bias. You can take the collateral out. You can do whatever you want with it. Another thing that the Ascent of Money has shown, which has been really interesting, is that once people have an asset that they can collateralize, and in Western society for the past century, it's been their house, that's been a huge lever of financial progress and financial freedom, because people can finally they can leverage themselves and open a business or pay for college, and they can access kind of the capital markets in a way that they never would have been possible for them before. And that's part of the promise that DeFi can offer. Now, we definitely need more I'll call it self-aware developer teams, because the development pace, the incentives these days are completely misaligned, where you know that even if you get hacked, you'll be able to make out with your own reputation intact and with your own funds. And a lot of companies that have been hacked, nothing bad has really happened to them, and so there's no we're in this place of moral hazard, and that's very alarming to me, because if you're developing something and you're asking that not only people but other protocols trust what you've built, and one of the problems with DeFi and code in general is that this is just abstraction upon abstraction upon abstraction upon abstraction, and we really don't know what those risks are anymore unless you go really deep. Then there has to be consequences for the builders who build badly, and without that we really approach moral hazard. And I'm just going to shout out two projects that I think have been doing this the right way. One of them is Thorchain, which has built a cross-blockchain basically a blockchain that lets you bridge from Ethereum to Bitcoin, from Terra to Bitcoin and Ether and all of those in a native way. So it's not wrapped or anything like that. It's actually, you swap your Ether and you get Bitcoin, and they do this through their own native blockchain. And they've been rolling out their blockchain very slowly over the past 2 years, because they're saying, listen, we've built this and we've audited it and we've done all we can, but we know that there will be bugs and we know that there will be exploits, and we don't want a main net public launch until we've battle tested this. And you know what? They were right, because the system has been hacked over the past year 2 or 3 times. But because they've taken this slow and steady approach, each time that the hacks have occurred, by the way, mainly on the Ethereum nodes, the Ethereum blockchain part of it, because of the complexity of Ethereum versus other blockchains, because they rolled it out slowly, their treasury of the project can backstop it. And only once they've battle tested it and had the protocol out in the wild where real hackers are incentivized to hack it, do they feel confident enough to release it to the public. And even then, they are fairly confident that these things will happen again, because you need time as diversification. That's one project that I think has been taking a smart approach and a good approach. And it's not the quick, the get rich quick approach that other projects have taken, but I think it's the right one. Another one has been Liquidity. Liquidity offers people loans based on ETH collateral. And much like Uniswap, this is an immutable contract on Ethereum. There's no governance. They can't change it. There's no risk of a multi-sig getting hacked or anything like that. These are immutable contracts, and so they can't be regulated either. And it's just there on chain. You can read all the documentation. You can read all of the code. It's all completely open. Instead of using one oracle, they use 2 oracles, so that if one of them fails, then there's a backstop. Is that enough? I don't know. I feel like there are edge cases where maybe 2 of them will fail, but who knows? And yes, there's definitely risk. Because it's immutable, then there is no white knight who can come in and save you. On the other hand, there's no multisig that can be hacked. There's no regulation that can come and crack down. So it's all a trade-off. And we've touched on a lot of these topics in a bunch of our read-throughs already, especially on the governance and token voting, and governance risks and ways to mitigate those governance risks. I think we had a read called by Fred Ursum on minimum viable governance, where the idea is to shrink governance to as few factors as possible that really make the difference. And on governance, also here, decentralization is a spectrum. And we're going here into kind of a risk bucket of, if the multi-sig contract, Polygon, this is one thing that's very concerning. Polygon is controlled by 5x9 multi-sig. It's got billions of dollars in value on that chain. And what do? Do you just trust this team? Do you not trust this team? And here again, decentralization is a spectrum. And the question is, what are the risks you're taking and what are the benefits? And so in some ways, yeah, Polygon is completely centralized, that these this 5x9 multisig can completely drain the contract. On the other hand, it's decentralized because anyone can write a contract to Polygon and anyone can deploy a contract on Polygon. And so you can also build these DeFi Lego blocks, and the composability exists. And there is no central controlling authority who's vetting the API usage, quote unquote. And that's why decentralization is a risk. And every participant has to ask themselves, what am I putting at risk? And what are the benefits? Overall, this industry needs to evolve to become more self-sufficient and less reliant on the traditional financial industry. Because if you have choke points in fiat on and off ramps, then we're still stuck. And if you have choke points where stablecoins need banks to custody their assets and they can be regulated, and then the stablecoins have to freeze different wallets or do KYC, then again, we're stuck. And we'll only get there when the usage of crypto becomes prevalent that you don't need to off-ramp into fiat, except to maybe pay your taxes. But a lot of regular commerce will be happening on the blockchain, whether it's on Lightning, Ethereum, rollups, or whatever it is. That is something that I'm very convinced of, that we need to be moving towards becoming less reliant on the traditional financial ecosystem, because regulation is coming. My big theory has been that in 2022, we're going to see a big push towards regulation. And what the government can regulate, they will regulate. That's just how the incentive of government is structured. And to avoid that, we need to get away from this system. I hope you've enjoyed this read. It's been a monster 2-part episodes, but I really think it's an incredibly important topic. If you're interested, by the way, in decentralization, there's a great podcast by Chris Bleck called Proof of Decentralization, where he goes deep with different protocols on how centralized or decentralized they really are, and kind of tries to stab at different points of vulnerability, different fragility points in different protocols. So I highly recommend that one. And until next time, Mieczysław Zlatogorsky, and this was Ethereum Audible.